So yeah, from time to time we get questions from people that want to loan money either to a friend or their family members, and they have some questions concerning that. And there are some rules that you need to be aware of. And if you structure it properly, not only will the person paying the loan potentially be able to deduct the interest, but if they fail to repay the loan, you may be able to take a tax deduction for it. But you got to do everything properly, right? The first thing that we recommend that you do is get a good legal document in place. Get a note. You want it to spell out who the borrower is, the amount that's going to be borrowed, the repayment terms, the interest rate, any collateral that's going to be held. Just like you would with a bank or any other kind of lender, you want to have that legal document in place. The IRS actually has some rules surrounding that, right? And what you want to try to do is avoid what's called below market loans, right? And that's whenever you don't charge an interest rate. And you can avoid those rules, which I recommend you try to do, because it can be a little bit more complex when it comes to taxes. One of the ways you avoid that is, there's certain loans that those rules don't apply to. One of them is if the loan is $10,000 or below, and you didn't use the proceeds to buy like a revenue generating asset, like stocks or something like that. So if it's under $10,000, generally you don't have to charge interest on it. Or if it's $100,000 or less, and the borrower doesn't have $1,000 of investment income, then you fall out of those below market rules. So we really try to avoid that at all possible costs to avoid having to get thrown into those rules and meet some of those standards. So if they default on the loan, right, you could potentially take that as a tax deduction. And what you're going to want to do is you're going to actually go through collection efforts, right? I'm not saying you got to sue them or anything like that, but at a minimum, what I would do is I would have some formal communication sent to them requesting payment, things like that, and then get, formal communication back for them stating that they're not going to repay it and here's the reasons why. And then if you have all these things showing that the debt is now uncollectible, you could write that debt off on your tax returns. Now, when you rewrite that off, it's going to be written off as a short-term capital loss, right? So you do fall into the capital loss rules to where if you don't have any other capital gains or anything like that, then you're only able to take $3,000 per year until the total loss is absorbed. So you don't lose it. You're just only able to take $3,000 every year until it's absorbed, or unless you have another gain to offset. So that's pretty nice to be able to write that off. And also another point to make on it is that, if it, like, say you're loaning them the money and it is for a house or if it was for a business purpose, that if you structure it properly, they can even write off that interest. But also understand that if they're writing off that interest, when you charge interest, then you have interest income. So you have to recognize the income as well. So yeah, make sure you're aware of that. It's not free money. So yeah, like I said, so there's some complexities in here, especially if you can't fall under those below market rules for the IRS that we probably need to discuss and figure out. But if you have any more questions on loaning money to friends or family, feel free to give us a call.